What's up, Investor Nation? The Capital Market Boys are back after sitting out a nice September. We thought we'd come back with a special guest and a special program in October. So this is one's close to home for Brian. We got his brother-in-law on, Paul. But so Brian, maybe you could do an introduction for Paul.
Yeah. All right. So big things here. So the capital markets, we always pride ourselves in. Bringing on new guests, bringing in not new guests, but bringing in and leveling ourselves up from a talent perspective. And we always wonder, where's your money come from? Where's your money come from? Where's your money come from? We get asked that a lot of times, whether it's from clients, investors. How do you do what you do? And so when you think about the different levels of aspects and different areas that capital comes into, this is like a one of a kind. This is a special. If you're an investor out there, these are the folks that actually make the decision, drives behavior. And so, Paul, I'm not going to steal your thunder. You can introduce us and give a little bit about your background and where you came from. But Paul's a portfolio manager for Voya. Portfolio manager, what that means, is like our loans that we're originating find its way into Paul's universe. And so, Paul, why don't you give a little bit of your background?
Yeah, thanks for having me, guys. Great intro, Brian. My name is Paul. I work for Voya Investment Management. I've been here almost 20 years now, coming up on 20 in March of next year. Grew up in the Northeast originally, did my undergrad at Rutgers, worked out in New York City for a company called Wilshire Associates for a few years before moving down here, and found myself working in fixed income for a company called ING, which a lot of you may have heard of, which eventually became Voya after the financial crisis. But we focus in fixed income. We have an equity desk up in New York. We have a bank loan team out in Scottsdale, a few teams out in California on the West Coast. But our bread and butter really is fixed income investing. So I specialize in the multi-sector fixed income portfolio. So great to be here with you today.
Love it. Thanks, Paul. And I think for our guests, what we're going to try to do is, like Brian said, our loans end up in one of Paul's portfolios or some portfolio and with someone similar to Paul. So what we want to do is kind of dissect that for you guys, tell you where RTL fits into the fixed income world. And then ultimately we're going to try to relate that back to what it means for you from a cost perspective, your borrowing cost perspective. So without further ado, we'll kind of jump into it, JD and Paul, around the interest rates.
Yeah, so this is just to give you guys the standard update that we typically do. We had the big moment that all of you guys were waiting for, the 25 basis point cut in September. So that happens, and different from a year ago, where when the Fed cut 50 basis points, we saw yields rise. Yields have fallen a little bit, so this is showing the 2 and the 10. They've trickled down a little bit. Right now, the 10-year is sitting around 3.98, I think. And the spread between the 10 and 2 remains pretty steady. And like we've talked about in the past, sort of that certainty. Certainty is good for the market. We saw another RTL originator do a rated securitization. So that's all sort of positive news. And then kind of just looking ahead, we've got a Fed meeting coming up. It's 98% chance now, 25 basis point cut. So that's a certainty already priced in. And then again in December, right now, market's pricing in a 90% chance of an additional 25. So we're getting 2 more cuts through the end of 2025. And I think something I really want to dig in with Paul here is we've focused a lot on these charts in our past webinars. This is the nominal 10-year, though. So something we're going to have Paul sort of dive into is the difference between real and sort of nominal yields. So, Paul, if you could, why don't you give a little bit of a breakdown between real and nominal yields?
Yeah, absolutely. I actually can't see the chart that you're showing there, but I know I did include something in the slide deck there where we kind of show you a history of the 10-year real yield. So think of nominal yields as two components. You have a real component, and then you have an inflation component. And the real component really driven by, growth expectations, macro factors, anything outside of inflation. And so the way we kind of dissect where we think yields are going to be longer term is we look at those two components and our expectations for them. So that's one framework. And if you've got the chart on the screen, which I'm assuming you do, you can kind of see that back in the, let's call it 90s, I think I've cut off most of the 90s in that chart. Fed funds rate was about anywhere between 3 and 6.5%. The 10-year real yields average 3.5. Then in the 2000s, Fed funds rate was a little bit lower on average, anywhere between 1 and 5.5%. And the real rates averaged 2%. So a bit of a drop there. Then from the great financial crisis through COVID, so most of the 2010s, Fed took rates all the way down to zero, and the rate primarily in the 0 to 2.5% range during that time period. Real rates average zero. So now that the Fed has taken rates back up, the Fed funds rate, we're closer to that more normal 2% level. So if you think that 2% level is probably the new normal of where the real yields are going to be, tag on inflation expectations on top of that, and you'll have where the 10-year nominal rate, kind of our target would be. So 10-year break-evens, the inflation component, since 1999 have averaged about 2.05%. And it's the same over the last 10 years too. So it's been pretty static. Over the past 3 years, that's climbed to 2.3%. So inflation expectations have drifted up slightly in the more recent term. So if we think inflation is going to be structurally higher than the past, which we do, we can assume 2.3 to 2.5 is here to stay for a while. So call it 2% on the real yield, 2.3 to 2.5% on inflation. That gets you to a 10-year of 4.3 to 4.5. So if you compare that to where we are today, I think Bloomberg showed that we're right at 4.0 earlier today. We may expect over the medium term, rates may tick up a little bit higher. That chart that I show with the real yields, I think, we're assuming a 2% average right now. It dipped down temporarily. I think it's at 1.7 right now. So maybe we get a little bit of a pickup in real yield. But that's kind of one of the frameworks that we use to think about where the nominal 10-year should be.
And what are sort of those, I guess, so what are the largest, what are the factors that drive sort of real yield? Because we're taking inflation out of the equation here. So what drives real yields?
So I think a lot of it is growth expectations. As you can see, it is partly driven by the Fed fund rate regime. So when the Fed funds rate was at zero, that real yield really got dropped down. Now we're not expecting the Fed funds rate to go back to zero. In fact, the Fed is thinking that terminal rate, what we call R star, the neutral Fed funds rate, is probably closer to 3. And if you take a look at where market's pricing it at, market agrees. Longer term Fed funds rate is anywhere between 3 and 3.25. So they have a 25 basis point lower and upper bound. And so we just don't think that the Fed funds rate is going to get back down to that zero rate longer term. And a lot of that is driven by some macro factors. Growth, high levels of growth will get your real yields higher. And so another way to think about it, actually, I think I have another chart in there talking about term premium. Another way to think about the 10-year yield nominal is what is your Fed funds rate? And what is the difference between your Fed funds rate and your 10-year historically? And if you take a look at that, we actually, I think I included a chart in there that shows the spread between the Fed funds rate and the 10-year. And you can see for the most part, it's about 1% on average. You can go back to the early 60s. If you take out the periods in there where the Fed was hiking rates and hiked the Fed funds rate up above the 10-year and basically inverted the curve, if you take those out as abnormal periods and only look at periods where the Fed funds rate is below the 10-year and the curve is normal, the average spread or term premium is 1.6%. So again, here, if you think that the Fed's terminal rate is going to be 3% and that your average historical term premium of 1.6 hold, that gets you, again, right about to 4.5, 4.6% on the 10-year nominal.
Paul, what would be some of what data would our investors look at? So the growth is incredibly important component to the nominal rate. What should they be looking at to factor in? Is growth exceeding expectations, below expectations?
Yeah, I mean, GDP is the most popular measure of growth, and our view is that it probably will trend a little bit lower for the remainder of this year before picking up. We actually have a pretty constructive view on U.S. growth for 2026, and a lot of that is driven by some of the stimulus that was introduced with the One Big Beautiful Bill. So you've got fiscal stimulus coming from the government in the form of tax reform and broader deregulation that is expected to drive some of that growth. You've also got, as Jack was saying, a Fed that's started their cutting cycle and poised to continue it at least for the next two Fed meetings. Beyond that, at least in our crystal ball, it becomes a little bit hazier. But so you've got both fiscal stimulus and monetary stimulus should help growth. And you should see that in GDP. Another measure that we look at, of course, we're in the middle of earnings season, so corporate earnings should show pretty strong growth. You've got a pretty bifurcated story in corporate earnings. You've got large corporations that seem to be doing very well. They can absorb some of the impact from the tariffs, but they also benefit from some of that deregulation and the tax breaks that they're getting in the fiscal package. Conversely, if you're looking at small businesses, their earnings are starting to decline. They're not negative, but they're not trending as strong as they were. So they're having a little bit tougher time absorbing some of the tariffs, and they're not going to get the same benefits from the deregulation. They weren't as burdened by a lot of the regulatory requirements as the larger firms, and so they're not going to get the benefit on the unwind of that.
Got it. At the end of this chart, you can see sort of, I guess, the spread between the 10-year and the risk-free rate has sort of, increased a bit when you're just looking at the 2020 to 2024 segment, which I guess you could probably call as like, Powell's regime. Do you think, like, looking ahead, obviously his time is coming to an end with like the new Fed chair, whoever it's going to be? Do you think that they can does the Fed have the ability to sort of control this? Do they try to control this spread between the 10-year and the risk-free rate?
The Fed can't control the 10-year. The Fed will tell you that they've got limited tools to use, and their primary one is that Fed funds rate. They certainly can use their balance sheet, so they can indirectly impact the 10-year by buying or selling treasuries or agency mortgages. They've done yield curve control in the past. That is certainly something that they can do. It's one of the tools they could use if they were trying to target the 10-year and lower it. But in terms of direct impact, the only tool that they have is to take the Fed funds rate up or down. And depending on what their goal is, whether their two mandates are, price stability and maximum employment. And those two often work against each other. So if you have inflation, but your labor market is weakening, you're in a bit of a conundrum, because if you try to take rates down to ease pressure on the labor market, you're stoking inflation pressures. And so right now, it's unclear where the major risk is between those two policy requirements, between their two mandates. They believe, and we think that's right, that the labor market is a bigger risk. And so they're probably going to lean toward being a little bit more dovish and taking the Fed funds rate down to ease some pressure on the labor market, with the risk that you would be stoking inflation. We haven't gotten a whole lot of data prints out recently because the government is shut down. And so at this point, we're kind of in a status quo mode where they started the cutting cycle and we think they're going to continue. But barring any surprises on inflation, anything that comes from tariffs, one, has been muted so far, and two, for lack of a better word, we think is going to be transitory. I know Powell got burned for using that a few years back, but that seems to be the way inflation is trending. We don't think it's going to get back down to their 2%, and we don't necessarily think that, a lot of folks in the administration necessarily want it to get down to 2%. But it is trending lower than the 2.9 where you see core PCE right now. And so I think the Fed's looking at it and saying, while inflation is a risk, we think that labor market weakness could be a bigger one. And so we're going to continue the cutting cycle for now.
Yeah. And that goes back to your, I guess, assumptions around the real and the nominal yield conversation, because historically the Fed maybe has targeted a 2% inflation run rate, but maybe now sort of the Fed and the market as a whole has gotten more comfortable with a little bit of a higher number.
I don't think they're going to say that.
But they don't want to say it.
I'm sure that there are conversations being had. And we talked about this before, where if you're any administration in charge of the government and you've got relatively higher nominal interest rates, at least, in the current regime relative to the past 10, 20 years, that's going to impact your debt servicing. So we've got a massive deficit, and servicing our debt is a large cost in that. And so you want to bring nominal rates down, and one of the ways to do it is to pressure the Fed to bring the Fed funds rate down, figure out a way to get the longer rates down. But another way to do it is inflate it away. And so, you may not mind running inflation a little bit higher than 2%. You don't want it too high. You certainly don't. The most important thing for businesses is to be able to forecast, their growth and plan for the future. And so if you have high inflation, it's much more difficult to forecast out and figure out how you're going to grow your business and how you're going to thrive. So certainly they don't want it hitting 3.5, but 2.5, I don't think is unreasonable behind closed doors discussions there.
Got it.
So there's a lot of good information. Next slide, Paul, is the 30-year mortgage rate versus the 10-year. Let's maybe try to tie it all together on how our borrowers and how they would look at. There's a lot of good information there. So what does it mean for their rates?
Yeah, so we thought this was. Go ahead. Sorry.
I was just going to say I love this slide because we get asked every webinar, well, when's my mortgage rate going to come down? When's my mortgage rate going to come down? So I'm happy, Paul, that you're here, so that I don't have to answer that question. But
however, I will say that JD did predict 2 cuts this year. We're getting 3, but in January he did call it right. So
fantastic. Yeah, that was very prescient. So
no influence of Brian at all.
Yeah, 0.
We like this chart. We've been looking at this for a while. So what we show here is now This is not going to be inclusive of all mortgages. This is a fixed rate 30-year national averages as published by bankrate.com. And it shows basically the premium of that mortgage rate over the 10-year treasury. So I think just the spread on the bottom there, you'll see the spread between the two, and you can see it's right about 240 basis points right now. I've drawn a line from the great financial crisis over through COVID, which sits right about 1.6%. So we are significantly above where the average has been. In 2022, it started to rise, as you can see. It got all the way up to 3.3% at its peak. And we think it was likely driven by servicers charging higher fees. There were a lot of programs implemented during COVID for forbearance and, borrowers not needing to pay their loans, and they can just tag it on to the principal and pay it at the end. And all of a sudden, this income stream that servicers had to, is basically a cash flow stream for their business, almost went dry. And so rather than counting on, this coupon that they could just clip, this business became a lot less profitable for servicers. And we think that at that point, they just started increasing their servicing fees on new loans to make up for some of the profits that they were losing on those forbearance programs. So we believe that if the government really wants to get mortgage rates down and make housing more affordable, which we think they do, that one way to do it, other than controlling the treasury rates, other than trying to force the Fed to take rates down, is to try to lower the spread somehow and cut 80 basis points to get it back to that 160 area. And one of the ways to do it, they can do it directly through the fees that the GSEs collect. Those are called loan level pricing adjustments. So the GSEs collect these pricing adjustments. Those can be directly controlled by the administration. They can take those down. They can also try to work with the servicers to have the servicers cut their fees. It's going to be a little bit more difficult. The administration doesn't have direct control over those, but they can certainly ask the servicers to reduce their fees if the administration removes some of their COVID area programs.
Yeah, that's helpful. That's super helpful. Sir, good.
So Paul, how about so you mentioned at the beginning, and I know you're running a fixed income portfolio. How many assets is there? What's the total size of your portfolio?
Yeah, so we manage here at Voya IM. I want to say it's 190 billion in fixed income. The total AUM amongst equity and multi-asset escapes me right now, but 190 billion of fixed income. The multi-sector portfolios that my team works on is around 50 billion, and the multi-sector portfolios that I personally oversee are about 16.5 billion.
All right, so every day you've got 16 billion. It's fixed income, so you're generating some level of cash through payoffs or refinancing, principal payments, interest payments, et cetera, that are coming in. How do you?
That's right.
What's the decision-making process of where to allocate those dollars?
Yeah, that's a great question. So all of our clients have built these mandates with us. They're called investment guidelines, and each mandate, each portfolio is governed by those investment guidelines. And those guidelines dictate the benchmark that we're managing to, what the outperformance target is relative to that benchmark, how much risk we're allowed to take, and what sectors we're allowed to invest in. And on the fixed income team, these are fixed income only mandates. So there's no equity, no alts in them. A lot of our institutional investors have very large portfolios, and they'll establish their strategic asset allocation among the broad sectors to equities, to fixed income, to alts. And then they'll hire managers individually for each of those sleeves. But once those strategic allocations are made, then they'll determine what the guideline requirements are for that mandate. And so we have, certain limits that we have to stay within. If the benchmark duration, for example, is 4 years, we have to manage it relative to that benchmark. We can be plus or minus a little bit, but we can't deviate too much. We have a certain amount of certain sectors that we can invest in up to a given amount, just to keep overall portfolio risk in check and in line with the guideline limits. So on any given day, what we'll do is we'll look at the macro environment, we'll establish our macro themes, and we'll do a top-down asset allocation among the broad fixed income sectors. Those broad fixed income sectors are government debt. So those include sovereign debt like US treasuries or German bunds, for example. Municipal debt, agency debt. Also includes corporate debt, asset-backed debt, which can be backed by auto loans, credit cards, aircraft leases, tons of stuff can be bucketed as asset-backed debt. And then real estate-backed debt. So this can be split up into commercial real estate or CMBS or residential real estate, agency or non-agency residential debt. And so within those sectors, we'll establish a top-down relative value. We'll take a look at what the risk-return profile is of all of those and set up an asset allocation. And then we'll work with all of the sector teams that go in and buy the individual bonds within those sectors. They'll do the security level analysis, and then they'll do the bottom up. They'll fill out their sleeves, so to speak, within each of those sectors to complete the portfolio. So we'll come in on a daily basis, assuming that our macro outlook hasn't changed. We'll look at market levels every day, assuming that our relative value analysis hasn't necessarily changed from one day to the next. We'll just make sure that all of our portfolios are in line to our targets and our risk tolerances.
How have you seen? So we're probably most interested in the mortgage allocation, the allocation towards credit backed by real estate that isn't CMBS. How have you seen that change 5 years ago to today? And then what are you guys thinking 5 years from now? Or maybe it's plus or minus 3 years. You personally, we know the views are you personally.
That's a tough one. Yeah. So here's what I'll give you some insight into our thought process around, and I'll focus on non-agency, right? So non-agency obviously has some credit risk versus agency mortgages where the government guarantees your principal as an investor, and really the only risk in agency mortgages is the timing of your cash flow. So a lot of work and analysis goes into modeling, prepayment expectations around both agency and non-agency because there is prepayment risk in both. But non-agency has that additional credit risk, and so it has a premium on its spread. One of the things that we look at in terms of assessing relative value is how does the spread of that sector compare to the spread of other sectors, because we are graded in the end by our outperformance of excess return over treasuries. And so we're not necessarily worried about what the treasuries are going to do underlying the bonds. It's really that spread above treasuries. And so which sector gives us the most attractive spread per level of risk? And risk is measured, broadly speaking, as volatility of your returns. And so if you're in a sector that either your returns are less volatile for whatever reason, or you have lower correlation to other sectors, that diversification is going to lower the volatility of your overall portfolio and track more positively on a relative value basis. So when we look at non-agencies, for example, you do have a pretty attractive spread relative to a lot of the other fixed income sectors. And you have a relatively lower correlation to some of those sectors. In fact, there's a pretty large institutional client of mine. They just sent me updated guidelines after I sent them a full analysis of historical excess returns and correlations of non-agency. And they added non-agencies. I can now buy up to 10% non-agencies in their portfolio. It's about $1 billion. And we're going to go into a meeting as soon as I'm done here, likely add about 2% in that portfolio. One of the changes that we made earlier this year across our portfolios was to add high quality, so AAA, non-agency jumbo mortgages. So these are securitized CMOs rated AAA, backed by jumbo mortgages. And the rationale for that, and these are 2021, 2022 vintage. Rationale for that is because you've seen so much home price appreciation in the housing market that it really reduces the credit risk of these bonds. And so you're getting that additional spread, but all of these borrowers have a lot of equity in their homes. And so the credit risk, the risk that they're going to default on those loans is significantly lower, not to mention that AAA already have a lot of credit enhancement built in. So if there are any losses in that trust, those will go to the lower tranches. But that was a strategic change that we made earlier this year, and it worked out very well for us.
Right. So if I was to summarize a little bit of this, portfolio managers, i.e. Paul, they've got benchmarks. How well the portfolio does against that benchmark, i.e. the spread, is whether or not you're going to book a nice vacation or not, how you're going to get paid. And so it's really, I guess, and there's probably a lot of components that go into that. But some, the spread to the 10-year or whatever those benchmarks are is super important. And so determining which asset classes you're going to go into or reallocate is going to drive that.
So when you think about non-agency and DSCR, which is going to fall into non-agency, what kind of risk premium are you looking for as a portfolio management to take that theoretical credit risk, right? Because I think what you did just explain, if you're an investor, is this is how these guys are making decisions. And now what we're going to tell you is where does DSCR fall in terms of the premium needed, which is going to obviously correlate to the, one, the prepayment penalties, and then two, the rates you're paying on the street.
So I'm going to give you a pretty nuanced answer to that. It depends a lot on the structure. So the spreads that you're looking at vary pretty widely from the AAA tranche of that deal to the lowest rated tranche of that deal. And so it's not as easy as saying, do I prefer a DSCR versus a prime jumbo versus a non-QM versus, an RTL. It's what part of the structure of the tranche do I want to play in as well. So, for example, a prime jumbo AAA is probably trading somewhere around 140 basis points over treasuries right now. 132 actually. A non-QM, the A1 tranche, a little tighter, probably around 125. And so I can't quite quote RTL deals. The last one I looked at was a little bit stale, and there are no AAA tranches. Those tend to have the highest rated that I've seen was a triple B tranche, which was somewhere around the 350 basis point range. And so it really depends on what your mandate will permit, whether it permits you to invest in investment grade only or allows you to go below investment grade. If you're required to have ratings, or it allows you to have non-rated tranches as well. And that'll determine where in the non-agency space you can play. And once you've established what your investable universe is, then you can make that relative value call between, non-QM, prime, jumbo, RTL, et cetera.
So that leads us to a point that Brian was bringing up earlier, which is not all lenders are created equal. So maybe talk a little bit about that, Brian, regarding what it means to have a platform that can face off with a Voya versus maybe a new entry into the market.
Yeah, 100%. So one of the things we were doing as we were, there was a little bit of preparation for this this call. We've been busy. Is diving into, as Paul alluded to, they've got a facet of different teams, and there's a credit team, a credit analyst team. They're looking at probably more elements of a transaction than we could appreciate. But a key component that's important to their underwriting decision is, where did the loans come from? Who is the originator of the loans? What, if you look at those loan documents, are they tied? Who are they tied to? Because that's like a trend in analytics that they're looking across all the loans that a company like iFund Cities underwrote. And so probably part of the reason we gave everybody on here some transparency in our underwriting last 2 months ago. But that having that relationship, having a meaningful counterparty. If you're a borrower, your counterparty's iFund Cities as the lender. And so having a meaningful counterparty has got to go a long way into your credit making decisions, because those are the folks that are established. Track record is we know how important that is.
Yep.
Is having that ability, that track record means a lot to the folks that Paul's working with on the credit side.
Yeah, I just want to add, Paul explained how he's multi-sector. They're looking at all these different sectors. There's probably a team for each sector. There are sectors within sectors, and the securities that they're investing in could be backed by thousands of loans. So they couldn't hire enough people probably to underwrite every single loan to that intense of a degree. So that reliance on good counterparties is super important for them.
And so having that platform, just if I'm hearing you guys correctly, is going to be paramount to having the most effective cost of capital for our borrowers out there. Those established platforms are going to be able to provide that service to our customers in a better way, more efficient way, which also means lower costs. So picking your counterparty, i.e. the lender, Mr. Borrower, is going to be key. Paul, I heard you say the spread on RTL was 350 versus 126. I'm going to go round numbers, and I get it's a risk premium, but maybe give the perspective of, we got a maturing industry here. It's becoming a structured finance play. Where do you see RTL, DSCR rental loans in terms of, in the next 3 years? Is that going to be a larger part of strategy for guys like you, or is it going to be perceived risk, riskier assets? And if it's perceived riskier, the second follow-up is, what needs to happen in the industry for it to be viewed as a more of a core asset, core plus?
That specific sector, RTL, I think is going to grow. And I'll give you the reasons why. One, ratings are very important to us. Most of our institutional mandates require 1 to 2 ratings by a nationally recognized statistical rating agency, or NRSRO. So ratings are very important to us. Most of our mandates require 1 to 2 ratings from a nationally recognized statistical rating agency, an NRSRO. Insurance companies also rely on what they call NAIC ratings, which determine the capital requirements that they need to hold. And so a few years ago, very few RTL deals were getting any ratings at all. And we're starting to see a lot more of the deals get at least 1 rating, whether it be from Kroll or DBRS. I haven't seen any cross my desk from the big 3, S&P, Moody's, or Fitch, but I'm sure that's coming. And as you guys work with the rating agencies to get them more comfortable on rating these deals, they will become more prevalent in these institutional mandates. The second part of that is the longer track record. I think, Brian, you alluded to this in terms of a track record. The more history you have on default and recovery trends, it'll also help a lot of the risk assessment of the sector. So more history there, the broader the sector is going to be utilized. And finally, as I think you guys mentioned, the counterparty underwriting is very critical. And so we can't do it on our side for these types of deals. We can do it for CMBS, where, some of the larger deals are 50, 75, 100 million. We can pick the top 10 loans in a trust and underwrite those, and we kind of get the risk of the entire trust. It's a lot different in residential mortgage securitized trusts, and so we really rely on you guys doing that counterparty underwriting and the trust that goes along with that. So to answer your question, I think that the sector will grow over the next 3 to 5 years. There will be headwinds. I think you're seeing affordability in the U.S. housing market becoming strained. I've got some interesting stats on that, but ultimately, I think it will recover. Ultimately, I think that you will see transaction levels picking up. And again, we're pretty positive on the medium term.
So maybe we can hit some of those housing things before we leave. But I think, so most of our guys, Paul, not fixed income traders, obviously, background isn't on fixed income. If you were to point to an investor and go, every morning you should look at these following items to understand a little bit more about how the capital markets are moving or how to forecast some of your rates, if you have a project coming online, like a new construction, what would you point to that they should look at every morning to educate themselves on where the markets are going or performing?
Great question. I'll tell you the top things I look at on a daily basis, and then maybe we can kind of broaden it from there. So I've got a little market monitor. Actually, I have it right here. I don't know if you can see it. A lot of little numbers on there. I print it out every morning. So equity indices are at the top. I don't much care about the levels. I care about the direction they're moving and where they've gone month to date, year to date. I then have a section on bonds. And when I talk bonds, I'm talking 2-year and 10-year. Those are really the 2 points I focus more on. And it's really just nominal. Like, it's nice to look at, break it down between real and inflation. But on a daily basis, I really just care what the nominal rate is. The 2-year focuses on the front end, and the 10-year kind of covers everything on the back end. So the 10-year being the slightly more important one. Then I look at spreads across all my sectors. The largest sector of which corporate bonds within my space, they're broadly trading about 80 basis points. So figure, the yield on a corporate bond will likely be, call it the 10 years right at 4% right now. The spread on the broad index is at 80 basis points, so call it 480 is where the all-in yield on your, 10-year corporate bond would be. Average, again, across all sectors. But I look across, CMBS, ABS, look at what the spreads are doing. Then a little bit more ancillary, more to inform my broad macro views. What are currencies doing and what are commodities doing? Because those are going to drive the macro stories. So you've seen recently that oil spiked today after there was an announcement of some sanctions on Russia. But prior to that, oil prices were coming down pretty precipitously. So those are the things I kind of look at. And again, it's really to just inform my macro view. Where is the economy broadly? What direction are we going? And how is the market interpreting that? So market and economy are two different things. The economy can be humming along, but the market is a forward expectation. And so you may see divergences there.
Super helpful. What else you boys got?
We could be here for days.
Should we let the people ask some questions?
Well, before we do that, maybe I'd love to see the housing appreciate. You have some fun facts. It sounds like, Paul, maybe you could, I know we're off topic on fixed income, but maybe you can give us a little insight as to what you saw on HPA or where you guys forecast HPA.
Yeah, we were talking about home price affordability. And there's a lot of talk about how the administration is trying to see what levers they have to pull to make housing more affordable. And there were 3 factors that were kind of thrown out in one of our discussions. What would get home price affordability to 2019 levels? One of these, or a mix of all of them, would need to happen just to get back to where we were in 2019. People's income would need to double, or rates would have to come down by 300 basis points, or home prices would have to go down by 40%. And so if you think about that, and by the way, for the home prices going down, I think part of that involves, changing zoning requirements to increase supply. So these are the kind of things that the administration can actually implement or impact. But even that would need to be done at the state and local level. So we were trying to think of, well, what levers does the administration have if one of their stated goals is to make housing more affordable? I think my vote personally is for doubling incomes. I don't know about you guys.
I love that.
Cover your ears, Jack.
Yeah.
And so do you think that's clearly not going to happen, right? Where that wage gap's probably going to close over the next 3 to 5 years, right? Or get closer. And so I think the most interesting thing you said was potentially the GSE and the servicing fees. Although I don't know the national servicers that aren't GSEs have that incentive because they have regulatory risk, right? So why would they underwrite that if they can't underwrite that risk if the administration changes? So how and what lever do we really have to move the needle here, right?
I think those are the two. I think it's 2 and 3 or some kind of a mix to bring rates down, whether you're doing that, through the treasury rate or through that spread above treasuries of the mortgage rate, right? And part of that, to your point, there is some risk that, if servicers bring their fees down and then the administration changes and regulatory environment changes, but they can always, take their fees back up. There's nothing stopping them from doing that. But that's certainly one avenue. And then, you can't necessarily impact demand. So you try to impact supply and increase supply. And how do you do that? You reduce regulation for where you can develop housing to the extent that you can, to the extent that the federal government has the authority to do that versus the state and local, or they work with the state and local and try to incentivize state and local governments to do that for them.
Love it. Boys, what else?
Yeah.
And then we can get into questions.
No, I think that was, it was helpful. It was helpful to see some of the things we've been talking about since over a year now when we talked about the securitization market, a rated securitization. What does that mean? How it's introduced more liquidity into the space, more appetite, kind of more the maturing of the asset class. Our customers are clearly seeing that. It's great to see how that impacts portfolio managers like Paul in their allocation and strategy. So it's been good.
So before we get to questions, one last slide, if we can pull it up here, is Paul's not only a beast in fixed income, but his daughter is a heck of a water skier. And so we got a fun slide just to humanize Paul because he's clearly extremely intelligent. To bring him down to earth for our customers or people like me, this is what helps.
Thanks, guys.
Yeah, so Paul can't see it, but we've got an incredible picture. Paul's clearly very talented, but there's a 2-year-old that's skiing here in one of the lakes down in Georgia, and it was one of the most unbelievable things you could see. Is everybody's kind of standing out. She was a celebrity this summer. Right before she turned 2, she was actually water skiing, and so I had to
very cool.
I had to do that there for Paul.
Thank you, guys. Got to start them early.
All right, what questions do we have here? And guys, I think what we'll try to do afterwards is take this, cut this in clips, but also summarize. We, Paul gave a lot of great points, so look for kind of a follow-up email summarizing those points for our borrowers.
All right. I saw your note that there was a 97% chance the Fed would lower their rate October meeting, but isn't that already somewhat built into the interest rate now? I did see the Fed would stop their quantitative tightening by no longer selling their bond holdings. Is that going to be a bigger bump in rates to come down with less inventory, or not enough to move the needle? I kind of want to. I mean, I want to kick it to our genius, Paul. How much of effect the stopping this sort of quantitative tightening has versus maybe like stopping the buying versus the actual lowering of the rate.
Yeah, so that stopping of QT hasn't really played into any of our discussion. So we're kind of looking past that, at least on our side. We may be wrong about that. But the initial comment about the 97% chance of a rate cut being priced in is absolutely right. What you see right now assumes that you're going to have a cut in October, a cut in December, and then 3 more cuts next year. We actually think that you're likely to get those 2 cuts this year, but next year, there's going to be a lot more data between now and then, which may show one of 2 things, which may show resiliency in the labor market, which would reduce the urgency to cut rates, or you may see a tick up in inflation, which also may increase the risk of reducing rates. And so it's really a change in the expectations that would drive a move one way or the other in rates right now, because everything that you see is already priced in.
Maybe we could, so we don't have a ton of questions, so maybe you two could take short end of the curve coming in, means better financing for lenders like us. What's that mean for RTL pricing and bridge? Maybe we can give a quick update there. You've seen that tighten really quickly this year.
Yep. And part of that goes into the cutting.
Yep.
If you cut the overnight rate that banks can lend to each other, then you can see sort of the 2-year come down a little bit steep in the yield curve, which is obviously beneficial for lenders like us who are also borrowing money to lend money. And so I think you'll continue to see sort of a, lender demand for these projects and deals and a fight on pricing.
Yeah, it feels like we took, if I think about the short end of the curve, that's a lot of where our RTL pricing is based off of. They call it, Paul mentioned it, mentioned the word duration a few times. RTLs tend to price off of the 2-year part of the curve. And so there's been, I forget the exact time period. Maybe you'd put it in the early summer, a little bit more uncertainty or where rates, what the Fed was going to do around interest rates. It feels like there's a consistent kind of view, at least you got through the end of this year and into next year, 2026. And so, we've seen, that certainty has caused us to get a lot more competitive on the pricing front. As well as what we're seeing out on the investing side, on our investor front. And so I think a lot of that certainty of where rates are headed, when you look at the forward curve of rates, there's, it's less 50-50. It's more like we got 97, but it's a little bit more defined, and there's a little bit more confidence around it. And so I think we've gotten a lot more competitive on our front because of those reasons.
Love it. JD, we got another one here.
Yeah, it's a good, tough one for Paul, I guess. But Paul, in your mind, where's the ideal place for rates to land? Where it makes sense for investors to buy and refinance, and also homeowners to sell?
So I assume that we're talking about the long rates here, right? So I think that we kind of discussed that our view is that the 10-year would likely land somewhere around, let's say, 4.5 longer term. So I think we're on the same page, if I understood what you were saying, as you guys, where you're going to have a steepening of the yield curve, where the front end is going to come down with the Fed cutting the Fed funds rate at least 2 more times. The back end, we're sitting at 4. We think that longer term, maybe 4.5. Is a natural place for the 10-year to be, just given the real rate expectations and inflation expectations. And then if you take on top of that, the 160 equilibrium spread between the 30-year mortgage and the 10-year treasury, that'll get you at what, 6.1% on the 10-year, not much different than where we're at right now. So again, the real difference there just being the higher natural rate of the 10-year. That said, I think that, talking to our mortgage team, they believe that if you see a 100 basis point rally, so rates coming down in mortgage rates, you're going to see the next refi wave hit, because anything less than that is likely not going to put enough borrowers in the money to refinance their mortgages. So they're viewing anywhere between 1 to 125 basis points, that kind of critical point in which the 30-year mortgage rate could rally and spur a refi wave. And by the way, that would significantly be a tailwind to that non-agency allocation that we put on in our portfolios, because those are all coming at a discount to par. So if those all prepay, they'll prepay at par, and we'll get all of that immediately into the portfolio.
Super helpful. Next question is, if the Fed delivers 3 more rate cuts, will it calm the markets or confirm the fear that something's breaking beneath the surface?
A lot of it depends on messaging. Jack, I'd love to hear your thoughts on this too. One of the tools that the Fed has at its disposal is forward guidance. It's telling the markets what they're going to do, and that kind of eliminates part of the need to actually do anything. So if they communicate that these are insurance cuts and they're just getting back to their neutral rate, I don't think you're going to see a whole lot of panic in the market. In fact, if you kind of looked right at what the markets were doing, how they responded to Powell's presser in the last meeting, he actually mentioned insurance cuts, and risk assets briefly sold off because they were hoping that it would be a little bit more than just a couple of insurance cuts. They were hoping that he would embark on a longer cutting cycle, because if you take a look at what's priced in right now, we've got 5 more cuts priced in. The first one coming in October, almost 100% likely that they're going to cut. So if that's right, that's pretty significant to get down to 3. If you're thinking just insurance cuts, that might mean 2, 3. So that would be an upside surprise to the markets, and they may actually not like that.
Thoughts, Bri?
No, that's
I think I agree. I think
we're not levitating off the Mag 7 and
Yeah.
AI, boys.
right. And looking at, I guess, you can look at some other things like consumer spending is still strong, other things. So I don't think anything's
How about
breaking.
Jamie Dimon saying frothy in the corporate sector, right?
Yeah.
Small business getting bankruptcies coming, which kind of Paul talked about earlier in this conversation. Lots to go there. We can go a lot of different places. Be here all day. What role do you think private lenders will play in the broader institutional capital stack into next year? Maybe, Bri, you can kick that one off.
great question. They get a gold star there. That's a great question.
Bri wants to know who you are. He's sending you a gift card. Tina gets a gift card.
I think I'm going to pick up on a bunch of sound bites probably that have been out there, at least on the stuff that we've. I think the banking sectors has a huge headwind coming at them, continuing for a significant period of time. They're going to open up. They're going to get more aggressive. They're going to play. They're going to continue to play a role. But we've alluded to on this call, the business models of banks are get deposits, get a mature, get their costs and infrastructure in place to make sure they got the right risk and controls. I haven't seen a regulatory environment that I think is, you had some positive, maybe the wrong word's positive, but you've got the CFPB that's taken, a less active role than they might have been in the past. That impacts banks. But I think the regulatory environment's going to remain there. And so the banks have just those natural headwinds around it that providing capital. On the supply side, so that's the bank supply. On the other counter to that, so that helps out private credit. That helps out folks like us, where businesses, real estate investors, developers, et cetera, all look for that capital. And then you have the insurance, which is a growing asset class, which is they're essentially deploying capital through strategies like a private credit strategy. And so as their balance sheets are growing, I would expect as they're growing, maybe it's still the same 10%, 15%, whatever it might be, allocation towards private capital, private credit. And so I would expect it to continue to be a huge a tailwind for the country and this business.
JD, any thoughts to add?
No, I think you nailed it. Last question is from Marvin. Hi, Paul. Thanks for sharing your time. You're very knowledgeable and, more importantly, honest with your answers. How do you see the commercial real estate market playing out between the lenders and borrowers who traditionally were a Class A top-tier borrower, defaults due to the high level of commercial vacancies that are behind borrowers? A little bit confused.
Yeah.
So I think he's saying once a high quality borrower, now I have a delinquency. How's that going to play into my rates? And moving forward, the ability to access liquidity. And so, Paul, you're happy to take that, or maybe that's a Bri JD question.
So maybe I can kind of chime in with the knowledge that I have in the area, which admittedly is less than what you guys deal with. But from our standpoint, we do invest in direct commercial mortgage loans in a number of our mandates. And we have a very large team here that underwrite them. They've got boots on the ground across all 50 states in the U.S., underwriting the different subsectors within commercial real estate. At this point, their strong preference has been and continues to be in industrial commercial real estate and retail, just given the technical in that sector of limited supply. There has really been no increased pipeline of retail properties available. And so they look at, the supply demand dynamics. Multifamily has been tested recently because so much supply has come on the market in that space. And of course, office has been just decimated and is very slow in recovering. And so the borrowers, we as a borrower tend to focus on the properties that we believe has better underwriting, more favorable risk return profile. And so while office is very attractive from a return profile, the risk is a little bit too high for us. So I'll answer that from an investor standpoint. From a borrower standpoint, maybe I could defer to Brian and Ryan.
So just real quick, just to summarize that, but if we have higher delinquency in an asset class, Paul, isn't it fair to say you're going to require a higher risk premium, therefore?
Oh, absolutely.
Right.
Absolutely.
So delinquencies as a whole across an asset class are going to be tough for borrowers. So the more delinquencies, the more risk premium Paul is going to need to buy that bond or allocate, monies into that strategy.
There's two factors to that. So there's delinquency and recovery. And so the underlying property values matter a lot. And so for a lot of these where we foreclose, we'll take over ownership of the property. And a lot of times we can turn it around because our underwriting has been on not only the borrower, but on the property itself. And so if the recoveries are high, then that also reduces our risk regardless of where the default rates are at.
Great point.
It's really a combination of those two.
And
Make one more point. That's why office is so strained right now. It's because you have these delinquencies and defaults, but the valuation is also not there. So you can take it over, you can manage the crap out of this property, but there is no buyer in the end, so you're just not going to recover your investment on that.
And then I'd add a couple points to the question, because sometimes this does happen where you've got we've got somebody that's behind on their payments. They're trying to figure out the exit strategy. Something's changed, cost overruns, whatever it might be. I could tell you there's the best approach is, if I take Paul's word there of recovery, the partnership, the transparency, the relationship, the picking up the phone, going at it together, that approach, I think that's one of the benefits of the private credit community, is to be able to look past some of those challenges. So everybody underwrote a multifamily to a 4 cap or a 5 cap, and now they're 6 to 7. And so we appreciate that, but preserving the value, the transparency, the time, the effort, it goes a long way in the relationship, especially with us, that it isn't somebody that's not picking up the phone, unresponsive. I could tell you that there's strategies out there that we work through on a regular basis to help kind of maximize the recoveries. But in order to do that, it takes a partnership with the borrower and that collaboration.
That is
great point.
100% the experience that we have as well. When we work with borrowers who are in any kind of distress and we can modify the terms of the deal, we do that. And it saves everybody a headache.
All right, well, I think we're out of questions, Paul. This is incredibly helpful, incredibly thoughtful in your responses. I would agree with Marvin on that, and I think a great education for our borrowers. So we appreciate the time, and I know the community does as well.
Absolutely. It's been a lot of fun. Thanks, guys.
Thank you,
guys.
Paul.
Take care.
So in wrapping, guys, I think what we'll do is we'll summarize. JD, maybe we can summarize, and we'll see some clips online, but we'll summarize and maybe put it out as a workbook for our audience, so you guys can hear what a professional at the fixed income level and institutional fixed income level, thinks about the market. And then next month, just preview, we're going to have a large local multifamily builder transition to a single family luxury builder on the coast. Why he did that, the changes he's seen in the home building market from a local level, which I think will apply. And then lastly, if you have a deal that you want us to underwrite, you always know where to find us at iFundCities.com. And we're looking forward to continuing to build relationships and hopefully providing value to the community. So thank you on behalf of the Capital Market Boys.